You wake up, grab your morning coffee, maybe scroll through your bank account and think, okay, I'm doing all right. I've got some money saved. Bills are paid. I'm being responsible. And then you go about your day feeling pretty good about yourself. But here's what nobody told you. While you were sleeping, while you were working, while you were doing everything right, you got robbed. Not by a thief, not by the IRS, by something far more invisible, far more consistent, and far more devastating to your financial future. And the craziest part? You thanked them for it. My name is Ben, and I spend way too much time thinking about the silent forces that drain your wealth without you ever noticing. If you're someone who saves money, tries to do the right thing financially, but still feels like you're running on a treadmill that's slowly speeding up, hit subscribe and give this video a thumbs up because we need to talk about the tax you pay every single day that has nothing to do with your paycheck. Now look, when I say hidden tax, I'm not talking about some conspiracy theory. I'm talking about inflation. And I know, the moment I say that word, your eyes glaze over because you've heard it 1,000 times. Inflation this, inflation that. But here's the thing. Most people fundamentally misunderstand what inflation actually does to them. They think it means prices go up. That's technically true, but that's like saying a heart attack means your chest hurts. You're missing the devastating mechanism underneath. Let me show you what I mean with real numbers, because this is where it gets uncomfortable. Let's say you're being responsible. You've saved $10,000. You put it in a savings account earning, let's be generous here, 4% annually. At the end of the year, you've got $10,400. You feel good. You made $400 doing nothing. Except, here's what most people don't realize. If inflation ran at 3.5% that year, which is actually lower than what we've seen recently, your real gain wasn't $400. It was about $50. $50 for an entire year of discipline, for 12 months of not touching that money, not enjoying it, not living your life with it. $50. But wait, it gets worse. Let's talk about what happened in 2022 when inflation hit 9%. If you had that same $10,000 in that same savings account, you didn't make money. You lost roughly $500 in purchasing power. Your bank account showed a gain. Reality showed a loss. You got taxed without a single form being filed. Now you might be thinking, okay, Ben, but that's just one bad year. It averages out over time. And I wish that were true. I really do. But let's look at the math over a longer period. $100 in 1990 would need to be about $240 today just to buy the same stuff. That's not growth. That's not your money working for you. That's the hidden tax compounding against you for 3 decades straight. And if your money wasn't growing faster than that rate, which for most Americans sitting in checking accounts and low-yield savings, it wasn't, then you've been paying this tax every single year of your adult life. Here's where the psychology comes in, and this is the part that really frustrates me. We've been trained to fear losing money. Behavioral economists call it loss aversion. We feel the pain of losing $100 about twice as intensely as the pleasure of gaining $100. So what do? We play it safe. We keep cash. We don't invest because the stock market is risky. We park money in accounts that feel secure. And in doing so, we guarantee ourselves a slow, invisible loss that we never emotionally register because the number in our account either stays the same or goes up slightly. This is the cruelest trick in personal finance. The thing that feels safe is the thing that's silently destroying you. And the thing that feels risky, like investing in the market, has historically been the only reliable way to outpace this hidden tax. Let me give you a real scenario. 2 people, same age, same income. Person A saves $500 a month in a high-yield savings account earning 4%. Person B puts that same $500 into a broad market index fund, averaging, let's say, 8% historically, which is actually conservative for the S&P 500's long-term average. After 30 years, person A has around $340,000. Sounds great, right? Person B has over $740,000. That's not a small difference. That's person A working an extra decade of their life to catch up, all because they chose the option that felt safer. Now look, I'm not saying savings accounts are evil. You need an emergency fund. You need liquid cash for short-term goals. That's non-negotiable. But here's the thing. Every dollar sitting in cash beyond what you actually need is a soldier you've sent to fight a battle where they're guaranteed to lose ground every single year. And this brings me to something even darker that nobody talks about. This hidden tax doesn't hit everyone equally. If you're wealthy, if you own assets, if you have real estate, stocks, businesses, inflation actually helps you. Your assets inflate in value right alongside prices. You're playing on the winning side of this equation. But if you're working class, if you're middle class, if your primary form of wealth is cash in a bank account and a paycheck that barely keeps up with rising costs, you're on the losing side. This isn't just a financial phenomenon. It's a wealth transfer mechanism disguised as economic policy. The Cantillon effect, first described in the 1700s, shows that newly created money benefits those closest to its source first, and by the time it reaches everyday workers, prices have already adjusted upward. You get the inflation, they got the advantage. So what do you actually do about this? Because I don't want to just depress you, I want to arm you. First, you need to change your mental framework. Stop thinking of uninvested cash as safe money. Start thinking of it as melting money. It's ice on a warm counter. Every day you leave it there, a little more disappears. That mental shift alone will change your behavior. Second, calculate your real return on everything. If your savings account pays 4% and inflation is 3.5%, your real return is 0.5%. If your investment grew 8% and inflation was 3.5%, your real return was 4.5%. Always subtract inflation. Always know your real number. Third, invest consistently in assets that have historically outpaced inflation. Broad market index funds, real estate, I-bonds for a portion of your portfolio. The specific vehicles matter less than the commitment to staying ahead of the melt. Fourth, negotiate your income relentlessly. If your salary isn't growing by at least inflation plus 2 or 3% annually, you're taking a pay cut while being told you're stable. You need to advocate for yourself like your financial life depends on it, because it does. Fifth, and this is the one nobody does, protect your raises from lifestyle creep. When you get a 5% raise, if 3% of that goes to inflation-adjusted expenses and the other 2% goes to a slightly nicer apartment or car, you've captured zero real benefit. Bank the difference. Invest the difference. Make your raises actually count. Here's what I want you to take away from this. The most dangerous taxes are the ones you can't see on a pay stub. The most dangerous losses are the ones that don't trigger your loss-aversion instinct. You have been paying a tax every day of your life, and no one sent you a bill. No one asked for your consent. And most importantly, no one taught you how to stop paying it. But now you know. And what you do with that knowledge is the difference between spending the next 30 years getting slowly drained or spending the next 30 years building real wealth that actually grows faster than it erodes. The game is rigged against people who don't understand the rules. Today, you learned one of the biggest rules they don't teach in school. Use it. If this changed how you think about your money, subscribe, because this channel is about understanding the game well enough to actually win it. I'll see you in the next one.